The stock market is currently closed, and as of the final bell on Friday, January 23, 2026 at 4 p.m. EST, DataVault AI, trading under the ticker symbol DVLT, finished the session at $0.8161. While a sub-dollar price point often suggests a company struggling for breath, the most surprising data point right now isn't the price itself, but the massive disconnect between management's aggressive 2026 revenue projections and the immediate threat of being kicked off the Nasdaq exchange. On January 20, 2026, the company received a formal delisting notice because its shares had spent 30 consecutive business days below the $1 minimum bid requirement. In a frantic attempt to fix this, a 12-for-1 share consolidation went into effect on January 22nd. Yet the price has already drifted back toward 81 cents. This means the market effectively wiped out the intended compliance cushion in less than 48 hours. Investors are watching a high-stakes game of chicken, where the company is projecting over $200 million in revenue for next year, while the exchange is counting down the days until January 29, 2026, when trading could be suspended unless an appeal panel intervenes. The common market belief surrounding DataVault is that this is a classic high-risk, high-reward bet on the infrastructure of real-world asset tokenization. Most retail investors are focused on the headline-grabbing partnerships and the massive guidance raises, believing that once the company scales its high-performance computing network across its planned 100 nodes, the stock will naturally find its way back to previous highs near $4. There is a sense of familiarity with the narrative that small-cap tech often faces these types of listing hurdles before a major breakout. People look at the IBM alliance and the expansion into the live outdoor event market through the recent acquisition of API Media Innovation as proof that the business is growing too fast for the stock price to keep up. However, a deeper look at recent price action and institutional behavior challenges that optimistic narrative. The recent sell-off wasn't just a byproduct of broader market weakness. It was accelerated by a massive disposition from one of its largest stakeholders, Silex Holding Company. Throughout the first weeks of January 2026, Silex offloaded nearly 15 million shares, flooding the market with supply at a time when liquidity was already thin. When a major insider or partner dumps a position of that size, it often signals a lack of confidence in the near-term capital structure, or a desperate need for their own liquidity, regardless of what the long-term guidance says. This selling pressure coincided with a pattern where positive announcements, like the integration of AI bias detection with FinTech TV, were met with immediate selling. It suggests that institutional players are using any bit of good news as an exit ramp, rather than a reason to double down. Trading volume has been erratic, often spiking over 90 million shares on days when the price is trending lower, which typically indicates aggressive distribution. When volume is high but the price is falling, it means the sellers are more motivated than the buyers are enthusiastic. Over the last week, we saw the stock attempt a rally toward 90 cents on heavy volume, but it was quickly sold into, leaving a trail of overhead resistance. The broader macroeconomic environment isn't helping either. With interest rates remaining restrictive and a flight to quality dominating most portfolios, speculative tech companies with negative operating margins of 700% are finding it nearly impossible to attract the kind of sustained institutional buying needed to reverse a downward trend. To understand why the volatility is so extreme, you have to look at what the company actually does. DataVault operates through two distinct divisions that seem unrelated on the surface, but are tied together by data monetization. The Acoustic Science Division holds patents for wireless sound transmission, including the WiSA and ADIO technologies. They are trying to move this beyond consumer home theater and into live event data tracking. Meanwhile, the Data Science Division is building what they call a tokenomics industry, turning physical assets like gold, diamonds, and even carbon credits into tradable digital tokens. The business model relies on licensing royalties and transaction fees. Every time an asset is tokenized or traded on their exchange, they take a small cut. It is a brilliant model if it reaches scale, but right now the actual revenue is still in the low millions, while the expenses are in the tens of millions.
Short pressure has become a defining characteristic of DVLT trading. As of the most recent reporting cycle, short interest sat at approximately 42.49 million shares, representing about 16% of the float. This is a significant figure for a stock at this price point. Short sellers are likely betting on the delisting threat and the ongoing dilution from warrant exercises to keep the price suppressed. The borrow rates have shown intermittent spikes, suggesting that finding shares to short is becoming more expensive, yet the days to cover ratio remains low at around half a day due to the massive daily trading volume. This means a short squeeze is technically possible, but it would require a massive, sustained buying catalyst to force those 42 million shares to cover simultaneously. Retail investors can responsibly interpret this short data by looking at the fail-to-deliver numbers and the consistency of the short volume. If you see short volume making up more than 50% of the daily total for consecutive weeks, it usually means the bears are in full control of the tape. However, chasing a squeeze in a company facing delisting is incredibly dangerous. If the Nasdaq suspends trading, the stock could move to the over-the-counter markets, where liquidity dries up and spreads widen, making it nearly impossible to exit a position at a fair price. Comment how many shares you currently hold, and let me know if you think this short thesis is a valid reflection of the risks or just Wall Street trying to shake out retail. The retail sentiment on forums like Reddit and X is deeply divided. On one side, you have the believers who point to the 70-plus patents and the strategic location of their new AI and quantum center in Georgia as proof of a fundamental moat. They argue that the share consolidation was a necessary evil to stay on the Nasdaq, and that the current price is a gift given the consensus analyst target of over $4. On the other side, there is a growing chorus of skeptics who are wary of the constant stream of press releases that don't always translate into a stronger balance sheet. They point to the fact that insiders have been net sellers over the past 3 months, and that the company has historically diluted shareholders to fund its build-out. There are a few forward-looking scenarios to keep in mind. The first is the compliance scenario. If DataVault can successfully argue its case before the Nasdaq hearings panel and keep its listing, we could see a relief rally as the threat of being sent to the pink sheets vanishes. This would likely be the catalyst for the shorts to start trimming their positions. The second scenario is the execution scenario, where the company actually begins to recognize the revenue from its dozens of contract negotiations for real-world asset tokenization. If they hit even half of their $200 million target for 2026, the current valuation would look absurdly cheap. The third and most bearish scenario is the dilution spiral. If the company cannot secure non-dilutive capital and has to continue issuing shares or warrants to keep the lights on, the sheer weight of the new supply will keep a lid on the price, regardless of how many patents they own. The Silex investment agreement is a key pillar here, providing a potential $150 million cushion, but it is contingent on various approvals and milestones that are not yet guaranteed. Investors should watch the borrow rates closely. If they spike alongside a price increase, it might indicate the start of a squeeze. If they drop while the price falls, it means the shorts are comfortably riding the trend down. Upcoming catalysts include the January 27th deadline for the appeal request and the subsequent hearing. There is also the distribution of the Dream Bull meme coin tokens in February, which management hopes will drive engagement and liquidity in their digital ecosystem. While these are interesting developments, they are secondary to the primary goal of maintaining a major exchange listing. The expectation was that the 12-for-1 split would put the stock safely above $5 or $6 to provide a buffer. The reality is that the market sold it down immediately, leaving the company in the same precarious position it was in before the consolidation.
In summary, DataVault AI is a company with a massive vision and an even